Well, welcome everyone to another issue of TLG Talks. I'm Gene Trowbridge, a founding partner of Trowbridge Law Group. I've been in a few partnerships over the last 6 or 7 years, and this is probably the last version of what you're going to find me in until I go off and ride into the sunset. And one of the hashtags I use on my social media is Gene hashtag not retired. Okay, because there's been some teasing, if I guess how you would say it, of me over time on the website, but not retiring. And today I'm talking to one of the people that would make it awfully hard for me to retire. Good morning, Derek.
Good morning, Gene. How are you?
I'm doing fine.
Good.
So I'm very happy to have Derek Graham with me. If you want to hear or read a bio about Derek, I might have this wrong, but I think if you go to the website of l5invest.com, you'll see information about a company. Mike Flaherty and Derek Graham work together with me, and we've done over 20 offerings together, Derek, and I really appreciate your business. And I can tell everyone that Derek and Mike is primarily in the syndication business in the multi-family space. So I'm happy to have Derek with me today, and I am going to let him talk in just a second. We're recording this, and then we'll play these interviews sometime in the month of October. And so that's when you'll be watching us now. So Derek, I was reading your bio, and it's heavily involved with commercial real estate brokerage companies. You've been with all the major brokerage companies as a broker, and I think you're still with one of them now, but I think our listeners would be interested in knowing, how did you get in the syndication business rather than just strictly being a street broker?
So I got out of college in 1985, and I started in brokerage in June of '86, and I was a leasing agent for high-rise office buildings in a submarket called Warner Center in Los Angeles. And I did that for 10 or 12 years. And then I converted or evolved into an investment sale broker in the 90s. And that was a time where brokers didn't have to be specialized. I'd sell office buildings, industrial parks, retail, different geographies. Brokerage has evolved, as everybody knows now, where brokers sell assets in certain geographies, definitely by product type, and maybe a certain dollar price, dollar values between 5 and 15 million. So the specialization has changed brokerage a lot. In 2002, a client of mine that was a serial investor, he would buy pretty much every good deal I could find as a broker. He asked me on a deal. We were flying back from Memphis and doing due diligence, and he asked me, hey, I got to go raise some equity on this deal. If you think you know how to raise the equity, why don't we buy the deal together? You found it, you're the broker. And I said in my overly confident way, yeah, sure, that'll be no problem. And so I was in my mid-30s, I think, at the time. And I think the equity requirement was like 2.2 million. I literally had no idea how I was going to do it. So I think after that meeting, he and I bought together 40 properties. And every property, I'd say 3/4 of them I found as a broker. He would manage them. He did the accounting. He was a little older than I was, so he had the net worth to make it easier to get the debt. And I would raise all the equity. I'd probably raise 80 to 85% of the equity on every deal we bought. And so it proved for me to be a good, symbiotic relationship where I could stay in brokerage, make a lot of money in brokerage, and find deals that we would buy. And he and I were 50-50 partners. and I didn't have to worry about the operational side of the deals that we bought. So that's how I got into syndication, and I kind of played that out for a very long time, meaning I stayed in brokerage and still bought deals. So I think when I stopped doing brokerage, he and I had 20, 25 properties together at that point in time. So it was kind of an unusual way to coexist. I was able to keep one foot in both pieces of business, brokerage and syndication.
I talk about that straddling in my book, the first couple chapters. I talk about the possibility that there's really three paths you can take. You can look at syndication and say, well, I can't do that because it conflicts with my brokerage business, which I think it really does. I think it really can conflict. And then you can say, well, I don't care if it conflicts. I'll develop an internal policy and procedures manual that will let me do both without any trouble and still do the fiduciary and agency duty I have with both types of clients. Or with me, I got out of the brokerage business because I just didn't think I could do both. And I kind of liked the syndication business. So I just went into the syndication business. But your guy, who I believe you still have some deals left with you, right? There's still...
we still have 20 properties together.
Oh, 20 properties. Yeah. Okay.
Yeah.
He got there where most of us came from. There's some real estate out there that I'd like to buy, but I don't have enough money to buy it myself. Let's go out and get some partners. Right. That's where many, many of my clients come. That's where I came from, as opposed to just buying single family houses myself. I thought I could buy 10 of them at one time if they were stacked on top of each other, called apartment building. But I didn't have the money to do that myself. So I went out and learned the ropes of what a syndicator was. That's so common.
Yeah.
That's great. So now you and Mike are in business together, and you're out there buying multifamily properties. What is your strategy today in buying properties? You both have various roles and you do different things, and I know you find other people to do stuff with. What's your overall strategy?
Well, I'm currently a code managing member in 41 properties, 12 senior housing deals, and 8 commercial properties, and that's with my other partner, Kevin. And then Mike and I are partners together in 21 multifamily properties. So we have just a little under 6,000 apartments that we're the co-managing members of. And I decided 5 years ago to go all in on the multifamily sector. And I say that because I've been in significant number of retail properties. I'm in office buildings, industrial parks, flex, manufacturing, refrigerated storage, freezer storage, senior housing currently, meaning independent living, assisted living, memory care. So, I try to be humble and say, hey, look, I don't know everything, but I've really been an owner in a lot of different types of properties. And so 5 years ago, Mike and I had about 800 apartment units in Tyler, Texas. And I kind of took a deep breath, said, where do I want to spend the last 15 years of my career? And I looked at the 4 apartment properties that we had together, and I had a little moment of reflection. How did they do during the recession of 2009, 10, 11, and 12? And they held up better than any other asset type that I was involved with at that time, or really any time. And I kind of decided I want to go all in on multifamily for the rest of the duration of my career, And so Mike and I huddled, decided that we would stay focused on buying Class B, B minus, C plus in markets, and I'll get to that in a second, in markets that we found attractive. And we would focus on value add deals, meaning, which I think we all know what that means, but we'll go in, we'll cure the exterior deferred maintenance, and we'll buy deals where we think we can renovate the interiors with a kind of a standard scope of interior upgrades and raise rents in the process. So that's our business strategy. In terms of locations, our apartments range in location from, I think I'm in 13 different states, 31 different cities, with all of the holdings. The apartments are in 12 different states. I don't remember how many cities offhand, but we are in Seattle, San Diego, Reno, Kansas City, St. Louis, Richmond, Virginia. So we try to pick markets that we do a lot of research, and we try to pick markets that we think have realistic economic growth potential. We want what a lot of people are looking for. We want to have, a decent sized market. We focus heavily on employment projections. We work with economists to help us devise these lists of cities that we target. And we're looking for strong employment sectors. We're looking for, university towns. If we can have, strong, transportation. We'd like it to be in a lower crime submarket. We would like it to have these properties to have strong schools. So it's class B, B minus, C plus, value add, multifamily, and the ages of the properties we're looking at they're in the 70s and the 80s. We're dipping into some newer properties lately, one or two in the 90s and the 2000s, but that's not the norm. So that's our business strategy.
And you're going to keep that business strategy from what it sounds like for the next couple of years.
Yes. Yeah,
okay.
We'll stay. Once you kind of figure out the recipe, you just stay with it.
I get a laugh out of that. You said that you're trying to figure out what would you do for the last 15 years of your career.
Right.
And I sat at the kitchen table with my wife where all the great decisions in life are made, I truly believe.
Right.
And faced the same question. So I went off to law school 27 years ago. So it didn't turn out to be the last 15 years of my career. I'm still going, but that's what I did, because with me, the care and maintenance of partners, and we're talking, early 90s when I made that decision, was overwhelming. There were no third-party companies that provided back office help for managing the investors, not like the IMS, the companies that are around today. If those companies had been in existence, I probably would have stayed in the syndication business. I was raising all my money through the broker-dealer community, so there wasn't an awful lot to do, but there was still something. But I needed to grow, and in order, I had 850 investors at the last deal, and in 1 year I sent out almost 1,400 K1s, and I said, God, if I'm going to grow, I need more staff, more space, more this, more headaches. I think I'll move on. And I know that you and your company, and Mike, you have back office support, so you handle all that, and with at some point of time with enough volume, you can afford all that. Afford all that in-house. That's interesting. This is a little off of the questions that you and I were going to talk about, but I do know, because I do offerings with you, that sometimes you provide part of the capital stack for other people, other companies who go out and find the properties and chase the deals and come to you because of your relationship, and you will provide part of the capital stack, right?
Yes.
I've seen your org charts.
Yes. But there's a few qualifications to that. We call them joint ventures. You might have a different descriptor. We'll do that as long as, and you know me well, as long as we have 100% voting rights and control.
Total control.
And I'm always sensitive about how that sounds when I'm on the phone with somebody that's looking for that kind of relationship. But, I caveat it with, look, I just have never played that card. But I have to be able to make an executive decision if we're fundamentally disagreed on how to operate this property. Then the second condition is that we are heavily involved in the operations. So we don't just invest passively and then walk away and then hope it turns out for the best. So I'll have one of these, and it's probably an exaggeration to say I have one of these phone calls every other week with somebody that calls and says, hey, I'm looking for deals. Would you invest in our deal? And I'll give them this response, which is, yeah, we'd be glad to. We'd like to be your partner, but we don't invest passively. And if we do invest with you, we're going to need to have voting right control. Yeah. So most of those people don't like that answer, and then they go away. The people that I find that are receptive to that are people that are looking to grow their business, and this will maybe get to the next question that you're going to ask me. But I think somebody that's interested in that kind of a structure and a business relationship is looking at the big picture and the next 10 to 20 years of forming and growing their business, and they're not looking at it as from a next deal. Right. So I think it's a little bit of a vetting mechanism, which I actually like.
I think you've met them at one of our Crowd Converge conferences in Las Vegas, but I have a client I've done 114 deals with since 2014, yeah. And they only do that. They have 5 or 6 relationships, and they're count on those relationships who have strong track records on their own to go out and find the properties. And then the company raises $4 to $7 million, I would say, is an average, and come in and do exactly what you say, take total control, right. Maybe not for a very long time. Yeah. Maybe there's a planned refinance, or there's a relatively short holding period, right. And they in the weeds a little bit. You do 506B offerings.
Yes.
All of your investors are accredited.
Yes.
Right. That's what you do. So you don't advertise. Everyone's accredited. This other company I'm talking about does exactly the same thing. 506B, all accredited. And about 3 years ago, they closed their investor intake. They just don't have new investors anymore. And, I talked to them and they said, well, we're going to do this deal. And I've got 20 people and I can just simply mark them down for 50,000. I just know that when I bring a deal and call them, they're in for 50 grand, no more. And that's it. So, so 2 of my bigger clients, now you and this other company, do the same thing. And so there are product sponsors out there, right, who need help with the capital stack. There's no doubt about that. And that's kind of an interesting business. I have a couple of clients, Derek, who do funds of funds. My one client, maybe every other year, I'll raise $5 million, $500,000 a person, all accredited. And then they'll go out and they'll invest in deals $1 million at a time. And there are deals out there where the minimum investment is $1 million. Right. And not everyone can get in those deals. So that's what they do. And they invest their $5 million, and they're diversified and in big funds with big operators, quality properties, very, very interesting. So there's quite a bit of business out there to get involved, I see, with the capital stack for other people. You agree?
I do.
Yeah.
I do. Yeah.
And once you build the relationship, I mean, before we got on, we were talking about a company that you're going to maybe do the next deal with, and we've done many deals with them, and that's just a breath of fresh air, if you would, when they call and say, I think we found a property. We know exactly the documents. We know we're going to get confused over the org chart, but we'll work it out. And everyone performs.
Yes. Yes.
Everyone performs. So it's a good life, and it's built on your track record.
Yes.
All that only happens, Derek, because of your track record.
Yep.
And And a side question right now, I have people with good track records who are calling me right now and saying, I think we should do a blind pool.
Mm-hmm.
I think we should raise money as an acquisition strategy
Mm-hmm.
because when there's blood on the street, we're going to buy some property.
Right.
My advice is you don't know if there's going to be blood on the street right now. And we've been through this a few times in our careers.
Yes.
When you're buying something in that blind pool, blood on the street, how do you know that's all the blood that's going to be on the street?
Right.
You don't know what the timing is. So I believe in the acquisition strategy approach. I can now compete with 1031 buyers.
Yeah.
I can compete with cash buyers, and the cash buyers out there.
Yeah.
But I'm talking people out of doing that. Have you guys ever thought about doing that type of an offering?
No.
Good.
Yeah. No.
The other client I'm talking about says the same thing. No, we find a property and we know all the investors and they'll invest in it and we'll go on to the next property. That's what people want. I agree.
Yeah. Yeah.
And
I have people that ask me questions about that, or, would you form a REIT? Would you do this or would you do that? And, I kind of joke around when I say it. I go, I'm not really smart enough to figure that out.
Mm-hmm.
And I know that once you build a big portfolio and it works and you have this recipe down, there's just a big part of me that doesn't want to mess around with that.
No, I think you're right. And you're also, and I can tell this about you and Mike and your company, you've been around buying these properties long enough where your properties have done well and you've got great equity buildup. And over the last 2 years, you've been in the range of refinancing.
Yes.
Taking advantage of even lower interest rates, pulling cash,
Yes.
building reserves, giving it back, or even 1031.
Yep.
Every single month I'm doing a deal with a client who says, well, we want to exchange into another property, but we're a little short. Okay,
Mm-hmm.
good. So take that property, just like you did in Alamo or whatever the last one you did, 1, 2, 3. Remember?
Mm-hmm.
Arbor. Yeah. You had a client with 2 properties.
Yeah.
A lot of equity, but you're only about $6 million short from buying the property you all want to buy. So then you syndicated, and now we're in the world of tenants in common, which I'm not going to get into, but that's the result of the market being good, the cycle being good.
Yeah.
And thank God, I say anyone who made projections about what was going to happen when they were buying properties in 2011 and 2012 is a hero.
Yes. Yeah.
Anyone who made projections in 2006 and 2007 got their teeth kicked in.
Yeah. Yeah. Yeah.
It's all timing. So that's good.
Yeah.
So Derek, this has been great. I have one last question for you, and it's very important to my business. I get a lot of calls, and over the years, my ratio is usually 2 deals we do with existing clients and 1 deal with a rookie. It's about that way. And I, at the end of every month, I look at my list and I'm always trying to see, okay, did I get, 50% of my deals or a third of my deals from rookies? So what advice do you have for people who might want to get in the syndication business? And I call them rookies because they haven't done a deal yet.
Right. Well, that's you can sit here for an hour, right, and dole out advice. But I was making some notes. I think when you do syndications, there's 8 or 9, 10 things that matter. Number one, the deal. It's got to be a deal in a sector that makes sense and it's rational. Number 2, you got to have a skill to underwrite. I talk to lots of people that are ignorant about underwriting or overly confident or uninformed, and so it's a skill. You got to be able to raise investor equity. You got to be able to get the debt. You've got to be able to manage the property, whether it's self-manage or third-party manage. You need a track record. You talked about experience, so a track record, experience. You need a net worth to be able to qualify for the debt. You need a certain amount of liquidity to qualify for the debt. And I think you should know what those things are, those criteria are going in. You better have a great reputation. And you better have, it might be a similar thing, but you need credibility. And a credibility is a function of many of those criteria. So to answer your question, I think I used to work out at Equinox, and they had a slogan that we have all heard of, but I remember this one slogan: less is more. So the piece of advice I give to a rookie is find yourself a partner, a JV partner, a couple of partners, and don't be greedy and try to make a home run on your first deal, 2, 3, 4, 5, because there are so many things that go into purchasing, owning, operating, managing deals, properties, investments. And you need quality people that can fill the roles that you cannot possibly fill them all. So the partners that I've had in the past, both in brokerage and then specifically in syndication, like Mike is, he's probably the opposite of me in many personality traits and then skill sets. And I think you need complementary partners. So my less is more. Find some good people to work with. You can own it all and run the whole show down the road, maybe 20 years from now or 15 years from now, but do it right. Do it with less. You don't have to make it all, and find a couple of people that are good to work with. So
yeah, I kept listening to 1, 2, 3, 4, and I was wondering when you were going to get to what I think is number one. When I tell people what to do Monday morning to go out, if they're going to start, the number one thing is to find someone to do this with. I think it's an investor protection issue.
Mm-hmm. Mm-hmm.
It's good for the investors to have a good partnership running everything. It's a marketing issue. Derek, I love your deal. If I give you $50,000, what happens if something happens to you?
Yep.
Boy, if you can't answer that question,
yeah.
you are dead. And you're a street broker.
Right.
Okay.
Yeah.
You can find deals. That's great. But I bet back then you didn't want quarterly reports.
Right.
There's a property manager out there somewhere who
Yep.
couldn't find a good deal if a bus ran over him, but he can write reports and write checks.
Yep.
There's teamwork.
Yep.
Right there.
Yep.
And I say that's my number one step. My number two step is a database.
Mm-hmm.
You've got to always be building your database of people that you think you might have a 50% chance of investing with you, who you think that would be a good relationship for 5, 6, 8 years. Because maybe you don't have the same experience that I know, but I'm telling you right now, I know what goes on in property in 5, 6, 7, 8 years. I got all that. But I don't know what's going to go on in the life of the 20 investors in that deal. And that's where my headaches came from as a syndicator.
Yeah.
Someone's life changed. And in my world, Derek, I really never knew the investors because it was the broker dealers.
Right.
It was their Rolodex, and they'd bring investors to me. I didn't know. And all of a sudden, some lady calls and, John's dead and I need my money. And I go, well, what the hell are you in this deal for if that's a problem? So right. It's a people business.
Yeah.
Wouldn't you agree?
Yeah. I mean, it wasn't that long ago. This is going to sound whatever. We have, I've got 500 investors that have invested in once or 30 times. Currently, Mike has about 350. So it wasn't that long ago where I could look you in the face and said I'd been to breakfast, lunch, dinner, a Laker game, cocktails, golf with every single one of those investors. It's gotten a little bigger than that, but most of them I know well on a reasonably personal level. And then I have my assistant. She knows who their kids are, when they got married. She knows when they got sick. She knows when they, got divorced. She reminds me all the time of these things that you're alluding to, that it's mind-numbing how much is involved with personal relationships, i.e. your investors.
Yeah, it really is. It's really a people business. Well, Derek, this has been great. You've given us some great information, and the people who view this will be happy to hear from you. And once again, if you want some more information about generally how these guys do business, l5invest.com is a website. And somewhere in the next week, I'm going to interview Mike, and I'll be interested to see how he answers the same questions. But as always, Derek, it's a pleasure. Thank you for doing this. Thank you for your business. And say goodbye to everyone.
All right. See you later, Gene. Bye, everybody.
Bye.